Now we're going to talk about the real driver of our business. These guys have to meet each other first, so hold on, and then we'll be fine. Which is financing innovation. Really, we have to figure out what ROI is, and now we're going to talk about how these guys see it. Ladies and gentlemen, Ali Velshi and the group.
All right, great conversation, a very, very good series of sophisticated conversations going on here. How do we pay for this?
So you want to bring the level of conversation down?
That's right.
What you're saying, yeah, okay. Well, you know, and you looked at me, so you want me to answer. All right. The answer is not one way. I think that the thing that people got to realize in businesses is that multiple revenue stream businesses are good businesses. You work for one of those. Yep. You have 2 revenue streams at CNN. That's a good thing. Multiple revenue stream businesses work. When you can have a direct relationship with a consumer, which you didn't used to have, which CNN didn't have before it had CNN.com, you can start to do things differently. You can monetize it differently, transactions, subscriptions, lots of different ways. You can get into the whole data thing that they were just talking about. But the big thing I think is multiple revenue streams win.
It didn't always win for us, as you said, and now we get in touch with so many more people, and it's just a much more effective way for us to do business. But we wonder whether we can ever monetize it the way we do our old-fashioned business.
What's the name of the group? Ali Velshi and the group, and the 3 of us. So, well, monetize it. You know, I think if history has proved anything, right? If you deliver consumers businesses and you get 10, 20, 30, 40, 50 million, you know, unique users, download streams, and you bring the consumers what they want, you know, I mean, I think Apple proved that and everything else, you will find a way to monetize it. You may not find a way to monetize it day one, but I think you have a high level of confidence you'll find a way to monetize that.
I just give stuff away for free. So you know, I started Google Analytics and Google Voice, which are 2 products that we actually have a business model. We don't charge anybody, that being the user, and you get to use it for free. So if you're a Google Analytics user, you actually get to download the software or the code and put it on your website, and then we don't charge you a dime for it. And with Google Voice, which is also something that I founded and worked on, we also give away for free. You can get all your text messages, your SMS messages. You can make phone calls off of your phone and have that all sort of and not pay a dime for it. And we monetize that basically because the data is important. And it turns out that when you know more, you spend more. In the case of Google Analytics, advertisers that understand what's happening with their website, where things are not working the way they are, where they're actually understanding that Google or sort of results-driven advertising gives them a heads up on the competition. That's where they sort of allocate their resources. So in some sense, having that sort of back channel and that ability to monetize things in different ways, because it's not obvious that you have to charge them up front, actually helps.
But you benefit from the ubiquity of Google, as we'd all like to, right? We'd like to benefit from the ubiquity of the fact that you've got enough people, you've got enough critical mass that it makes sense. You can continue offering it the way you do. Is that how you see that model going out 5 and 10 years?
So the really funny thing is I'm an investor now at Google Ventures, and we're separate, we're independent from Google. We work with our CEOs today without the benefit of Google sort of backing them up. And so, there's these sort of fun conversations I have with the CEOs, which is, you got to make money. I'm investing in you as a business, not in you as a charity or a free giveaway service. And so we have those difficult conversations where we talk about what's a freemium service, what's the right approach to sort of give the value to the consumer so they understand it up front, but also at the end of the day, you need to make money off of this. So what's a great way of sort of making sure that that value, that you're getting compensated for that value we're delivering, and sometimes freemium is a way to do it. Advertising works to some degree, but you have to have a very, very sort of strong service and one that converts heavily for that to be profitable. But like he pointed out, there's many different ways of doing it, and you have to figure out what the right model is for you.
But could I just jump? Because just to be clear, freemium, but it's a path to something, right? It may be a path to gathering audiences that at Google Ventures, you'll then sell that to someone that'll use it as a feature to fit into something else that'll help monetize it because of helping more efficiently reach their audience or gather more audience. But at the end of the day, there's got to be a way to make money, whether it's over a 1-year period of time, a 10-year period of time, whether it's freemium day one, whether it's a feature. It's a simple question, how do you make money? But I think at the end, every one of these has a role in making money somewhere.
If you're not using the internet simply to sell, if you're not using digital distribution simply to sell a product where there's a return, where are we in the stage of determining the value production in using it? In other words, you're saying there's different ways to do it.
Right.
Where do you think we are in evolving as to how much we'll get if it's revenue from advertising? How much we get if it's revenue from eyeballs? How much of it is it from the ubiquity that allows Google to offer things for free?
I think a lot of it's just from testing it out, right? And half the time the business model is sometimes not obvious. You can do a freemium service. One of the companies that I've invested in, it's called Optimizely. They do this A/B testing service, and at the beginning they said, let's charge for this because people need A/B testing, which is a way for you to put up a different ad or a different button on your website and see whether it converts more. And people didn't quite understand that was something that they needed. So they sort of gave a freemium service. They gave certain functionality away for free, and then sort of hooked people on there. And then afterwards, people started rushing in and sort of paying for it because they said, wow, I need this some more. I want to deploy it some more. I need it to do more functionality, and that functionality and that value was sort of made clear. So that's one example where the model was, let's charge for it at the beginning, and then run a bunch of tests. Let's figure out if it works. Let's give it away for free if we can, parts away for free so that we understand sort of the acquisition cost and the chain in that, and then monetize it where for the folks that really believe in it, who understand that value, they're willing to compensate you for it. So that's one model.
Richard, you had a thought in our last discussion.
Oh, no, good.
I'm sorry.
Well, I think a couple of things. One, I like freemium models, and I think they do, in general, they can work. You hook a consumer or whoever it may be, and then they see greater value and they want to step themselves up. I think one of the other issues, though, in this whole transition to mobile is the phrase analog dollars to digital dimes to mobile pennies. There's some truth to that right now, and it's scary because everyone who sort of managed to eke out a living on the web now has to figure out the mobile web, and the money isn't there yet. Some of it's subscription through an Apple store or Android stores and so on, but it's not that big yet. And so we have the consumer once again getting out and the technology getting out in front of the monetization. And the monetization hasn't yet caught up in mobile, but that's got to be the next big thing because the world is going mobile, and that's not just it's an obvious statement, but it's a really obvious statement, meaning the next 1 billion and 2 billion people who get on the internet are going to get on through mobile. So that's sort of, in many ways, we got to also not fight last year's battle, so to speak. We got to get into the new battle, which is how do we get mobile monetization.
So in we share the same sort of ways of doing things, and our idea on mobile is pennies is one part of it, but it creates our presence all over the place and hence improves our brand and perhaps drives people to the place where we actually make more money. That model will change. It's probably on its way to breaking, and we have to figure out what the next thing is. Wesley, how do you confront the idea that it is pennies at mobile? Does it matter to you when you're pricing something out?
Yeah, mobile is one of the things where I don't think the nut's been cracked yet, and we struggle with our portfolio companies every day. We have folks that release apps that sort of build things just for mobile itself for the purpose of it, and then they're like, oh, I can charge for the app or I can charge for the service later on, and then when they build it, people don't come, and so I unfortunately sometimes have to have these unhappy conversations with some of our founders. The important thing about mobile is that it's a great distribution channel to sort of again further your brand. So that's the key thing. Getting as many sort of folks in that brand, that service that you have is important. The services that have tended to do the best is where there's more value than just a mobile app that's delivered for you, because it is a distribution channel for a service rather than just being an app for the sake of having an app or a cute game that you sort of have. One of our sort of best investments was a company called NG Moco, which wound up selling to Dina. But they didn't just have a game that you would pay 99 cents for. They had a game that was a service that it delivered you. There would be things that you would come back for every day, things that you would build, that you would work with other people and sort of collaborating, and then they wound up monetizing based on that service that you would pay for through virtual goods or anything else in that interactive experience, and they wound up being able to actually make quite a bit of money in terms of that value exchange of having a service where the game is the channel that service is distributed through your phone. So I'm a big fan when there's more than just an app that's delivered. It's actually a service that's valuable that people find useful outside of just the phone itself.
Richard?
Yeah.
Which
Same
reminds me, Richard, we didn't have that slide up there, which we had in the beginning. So tell us, for people who don't know, what you do.
Okay, so so my background, actually, John and I grew up a little bit together, and I grew up in your company right now at Time Warner. And after that was with Viacom and helped run both those companies. And then for the last 6 years, have been working in the media and technology and running the media technology practice for firm T.H. Lee. And we've got investments such as Clear Channel, Univision, the Nielsen Company, all in media. Recently, I've Warner Music that we sold to Len Blavatnik during that period of time.
So your take on this then, because we all share the same issues. We understand why we've got to move toward distribution methods that get us less money per user.
Well, so my take is probably a little bit, maybe because I have a little different direction, owning a bunch of traditional media companies, and maybe just to point to Clear Channel, because great, maybe a great example out there. So we bought Clear Channel a number of years ago. We didn't really look at it as a radio company for the radio part of the business. We looked at it as this powerful distribution arm, that digital technology that would greatly enhance as you went forward. So if you look at what's happened in the last 4 or 5 years, I think it's pretty instructive. So we reached 250 million people on terrestrial radio a month on Clear Channel. And by the way, just as an anecdote, radio listening is higher today than it was in 1970, overall radio listening, which comes, I see like people raising their eyebrows, which is a surprise, but it actually is 12 and over higher than it was in 1970. Our digital offerings, if you look at what's happening on the digital side of radio, we announced something called iHeartRadio about 2 years ago. Little known fact that will hopefully become more well known, we reached 10 million registered users in iHeartRadio quicker than probably any service that anybody's familiar with in this room, quicker than Facebook, quicker than Pandora, quicker than Spotify, quicker than Pinterest. We reached 10 million users. Today, we touched upon mobile that's out there. We have 155 hours of streaming music on our mobile apps. We have 55 million users. We've got something like 17 users on iHeartRadio. And the only reason I bring all those up is because you see in a 2-year period of time the power that happened in digital radio, but it wouldn't have happened without the terrestrial side. So I'm a huge believer in terms of the impact it has on us, is looking at some of these traditional media assets and then saying, how do you take advantage of the scale you have? How do you take advantage of digital technology, which we did led by Bob Pittman and the management team we brought in, and then how do you bring, whether they're dollars, dimes, or pennies, how do you try and capture the dollars, the dimes, and the pennies, and capture all them as the consumer is migrating more to mobile, or more to digital, or more to any applications we don't even know about today.
Jonathan, let's talk about this again, back to our business. Where do you fit into the whole discussion about how much you take our traditional media, which is still somewhat traditional? I mean, we are still over at CNN. We are on every platform there is, but we think of ourselves as a TV operation. And our advertisers still think of us as a TV operation, and that's where we make most of our money. And you got to sit there and say, how much of that do you use the digital side to prop up and enhance the brand versus start pulling the company in this direction that says the future's over here? Or is it? I mean, you listen to people selling ads, they'll tell you, no, it's TV. It's going to be TV forever.
Well, TV is a good business. I mean, here's the thing. People like TV, and there's a lot of great TV out there. So first is TV is a good business, and it's going to stick around. I think the demise of TV, anyone who's proposing that, is not going to be proven true. I mean, I think that TV is going to be around and healthy for a long time. That's first. So there's nothing wrong with being in the TV business. On the other hand, I do think that what's happening in the world, and this includes TV, but certainly the digital world, is a real stratification between things you can call truly premium and almost everything else. And unless you're able to be truly premium, you're part of everything else, and the CPMs, the advertising rates, come way down and keep getting pulled down. There's a lot of pressure to keep pulling things down towards the lower end unless you're differentiated. And this is driven by a lot of different things, including technology. As the media buyers move to buying audiences versus buying environments. It used to be, it was great to be on a primetime show and to be next to, a #1 show, and it still is, but more and more it's moving to, well, look, if I know it's John Miller and I want to reach John Miller or Allie or whomever, I can find him here, I can find him there. Why am I going to pay 40 times more to find him over there when I know they're right here too? And I can get them for 40 times less. And that becomes a tough thing. So, and only a few outlets of any kind are going to be able to maintain that really premium position, and I think that's the game. If you're a premium brand like CNN and other leading brands in whatever media it is, you got to keep to the premium end, or you're going to get pulled way down.
Wesley, let's talk about deals. Let's talk about the stuff that you look for. It could be outside of media. How do you differentiate now? Because now, the digital offerings, software offerings, and apps. at South by Southwest and various things like that, and these startup buses. Pretty much anything's available, and if you put it out that you're looking for something, someone will build it. How do you differentiate?
Well, deals are very opportunistic. You know, it's sort of like when I found Google, it was not something that was obvious, and it turned out to work out okay. It turns out that one of my best deals in my portfolio, and I manage about 50 or so companies personally for Google Ventures, is a biofuels company, which has nothing to do with digital or media because it solves a real-world problem. This guy that we invested in has figured out how to turn trash, agricultural waste products like used corn cobs into 109 octane gasoline, and they can do it for less than $3 a gallon, which is pretty spectacular. And then it's 109 octane, so you can sell it for like over $6 on the open market. And the one key sort of intuition that he had, and again, intuition is very important, and an insight that's unique to our innovators and our founders that we back, is the ability to actually, rather than build a central refinery where you have to take your truck of used corn cobs or anything else that you're trucking, which is low energy density, very cheap, and you're spending a lot of money on the fuel to transport it to the refinery, you can actually bring the refinery to the harvest. So he's figured out how to actually put the entire refinery in the back of 8 or so semi-trucks and bring it to where the harvest is. And then you're basically taking the trash or the waste products a very short distance, turning it into gasoline, and then trucking out the very expensive gasoline to where it gets blended back into what you would pump out of the pump to make 87 or 92 octane. And it's innovations like that where you have key insights that get me super excited, and those are the founders that we work closely with. So we do media investments too. We do digital, we do mobile, we do investments sort of all over the place. Google Ventures is, I think, over 120 portfolio companies now, but it's those truly innovative, amazing founders that have a key insight.
That's interesting. So your innovation portfolio is not limited to the things. I mean, look, that's very innovative, what you just talked about. I spoke to some dairy farmers yesterday who they're looking at sort of on-site refineries for cow poop into gas. What do you look at these returns? Do you look at your potential return differently? Can you evaluate the stuff that's digital, the stuff that's media related versus the others? I mean, do you just like it because it's a good blended portfolio and it hedges?
I think you need to have that sort of diversity in your portfolio to achieve a set of returns that you want to achieve. Confidence intervals basically get better when you actually have more diversity, and it's important for us to sort of invest across the board. And there are great and amazing founders in all sort of every sector. There are great folks in media. There are brilliant people building mobile. And there's the one guy I found and met in Camarillo, California, who built this brilliant biofuels company that can sort of scale and turn trash into gasoline. So I think that's really important to be able to find folks in all areas, and that's sort of what we strive to do at Google Ventures. We're a separate sort of independent firm where we're paid on the financial return of our companies rather than on anything that is related to Google. We can invest in companies that are different from Google, sometimes even competitive to Google, because I think Larry, in helping start this fund, basically had the foresight to say it's more important for us to invest in innovators and have a strong relationship with them than to sort of figure out how to make Google more successful. So we can do things sometimes to the short-term detriment of Google for the long-term benefit of Google Ventures, which is I think a very sort of interesting and unique position today.
You never get that phone call to say, I can't believe you just financed those guys?
I get it all the time. And I sit there and I'm just like, it will make you and me a lot of money, so it will be great.
It's an interesting way of doing business. Richard, what's your sense of how you pick things you invest in?
Well, it's interesting. Jonathan and I were talking about this before. I kind of look at, the world we're in today of private equity in like its third stage, right? The first stage, which was like, 20, 30 years ago when no one knew anybody in private equity, and Tom Lee, who founded our firm, found a couple kids in a garage. He bought Snapple for X amount of dollars, sold it for a gazillion times more than that. Then there was a second phase where it was more financial re-engineering. And now I think we're kind of in the third phase. And the third phase is there's no more not any great financial re-engineering because the markets catch up, and they do catch up. And everybody knows 50 people in private equity if you want to do a deal, or 50 venture capitalists. So there's nobody finding anybody in a garage that doesn't know anybody. So our view, and I articulated a little bit about Clear Channel before, is to take some pretty big contrarian bets out there, and Clear Channel is a great example. When we bought Clear Channel, one of the largest, $20+ billion deal, one of the largest deals done in private equity, people said, "Gee, Rich, I can't believe you're buying a traditional radio company, terrestrial radio company. What are you crazy? Outdoor billboard company." But what we saw in that was we didn't look at it as a radio company that we buy in the radio industry. We saw something which I said earlier, that we were reaching 240 million people, on a monthly basis. And we said, gee, this has got to be the most powerful distribution arm in the country, and technology can only enhance that. And the same thing with outdoor. We didn't see stagnant billboards out there. We saw digital billboards where people could change them every 5 seconds, 10 seconds, give you the latest information on things like flight prices or airline prices or stuff at McDonald's or whatever it may be. So I think what we try and do is say, gee, where everybody's looking left at a traditional business, we try and look right, and these are the reasons we're looking right. It's a distribution arm that has take advantage of technology. Quite frankly, no different than when we bought Univision on Hispanics. So we have an 80% share of the Hispanic marketplace out there, and looked at, growing demographics, income, which all sounds easy today. And you say, gee, Rich, well, what's so great about that? You'll open the New York Times or watch CNN, and it's in there today. But 6 years ago, it wasn't that prevalent. 6 years ago, people weren't looking quite as much of Hispanic adoption rates on technology in the U.S. being a number of years slower than non-Hispanics, and looking at trends, how we could catch up and help accelerate that. So that's really the bets that we try and make out there.
Jonathan, I'm going to get a little free advice from you. If you're us, we partner with companies. We sometimes buy other small companies that can advance us in a space, and usually those are they are digitally innovative companies. But we can't invent all the stuff that we're actually going to depend on. That's going to be our backbone. So when you are a company that isn't going to be a developer in that space, but really need it for the technology. So you see regular where I see regular billboards, you see a space for a digital billboard. How do companies make those decisions? How do you catch that trend? I mean, can you just be going to events endlessly and meeting people like it was in the early in the 90s, or is there a better way to make these decisions?
Well, I'll tell you something your company did that I liked recently, and maybe it's a bit of a model. You guys bought a news aggregator called Zeit.
Right, and that's the kind of example I was talking about. We choose that kind of stuff. How do you make those decisions?
Well, first of all, I'm a regular user. I use it every day. I like the product a lot. I have no vested interest in it, but I'm happy to plug it. It's a great product, ZITE. But what I thought was interesting about it when you guys bought it is that it's an aggregator. Now, most people who are primary producers of news, such as CNN or some of the companies, other companies I've worked for, they struggle with aggregators. So in that case, someone had a thesis that aggregation mattered. And so it would seem, to answer your question, I think what you have to do is you have to be thesis-driven. You have to have a few things that you believe in. So even though CNN is one of the great news producers in the world, somebody, I don't know who it was in the organization, decided that also aggregation mattered, i.e. having things from multiple sources and having a foot in that.
Which stands in contrast to the idea of us as curators.
Yes.
Right? You can imagine the tension in a news organization where all we think we do is exist to curate information for people, but we realize that some people just like lots of stuff.
That's right, but that's what I'm saying. So you have to have that thesis, and then you go out and you find stuff that fits the thesis. But you got to start with that. There's another one right now. I don't have a vested interest in it yet, but I hope to, called Prismatic, that I think is the best personalization engine for content right now, and specifically around news. It's just come out of beta. But so the other part of your answer is you got to pay attention too. That somebody's got to be immersed in this stuff. Because, for example, Prismatic is very early stage. I think it's a great company, but it isn't yet on the sort of general radar. But it is.
And it's quite possible when we bought Zeit that there were a large percentage of people inside the company who didn't know what Zeit was.
Yeah. But in both cases, you'd have to have a thesis that said, I believe in aggregation and I believe in personalization. And unless you believe those things, you wouldn't even be looking in those areas. So I think there's got to be some folks in an organization that develop these theses and then really get out in the market and find out what's there.
And Richard, you too are talking about aggregation and personalization.
Yeah. No, I was actually, when John was saying that, I was shaking my head because I was thinking about some of the first conversations we had with Bob Pittman before we started iHeartRadio, and talking about everything from, because remember, we're private equity guys, right? So fundamentally, we're more conservative, right? So we're talking about everything from, cannibalizing ourselves, multitasking, and Bob said, wait, let's just take a step back here. One is we got to bring everybody news, weather, sports, music, wherever they want to have it. So either we're going to do it or somebody else is going to have it. Two is, people have been multitasking since he's got this great line since the 1970s when, our kids, when we were there, maybe we didn't have, we weren't doing Twitter and everything else, but we were sitting in the living room, you're watching TV, you're reading a magazine, you're picking up the phone. So what's the difference in that today? Right, so the population's already used to that. Today, we all act like this is something, and at least I know my kids, oh my God, like how can you do all that at the same time? Well, we were doing all that at the same time. It just had different versions, than we have there today. So you have to have that thesis and trends, and then build your products around, the way consumer habits are. And it's not, to me, it's technology following consumer habits.
Wesley, when you're looking at your investments, and you're in a different space than Richard is, are you looking for long-term trends and you're getting a foothold in? Are you looking for a shorter to medium-term return?
We want a return, right? Whether it's a shorter, medium one, or it's a long-term one. I'm always happy to have a return. But I think there's sort of some fundamental bets and things that are happening today. Mary Meeker calls this the reimagination of X, right? Whether it's the reimagination of how you consume news, the reimagination of how you're using your computer. And the beautiful thing today is everybody's got a mobile phone today. Like 10 years ago when I was in school, like it was my desktop computer. That was how I was getting all my information. It was that and the television. News would be on the television. The computer would be, maybe sometimes it would be CNN or New York Times I would go to, but that's fundamentally changed. You see people getting information today from their phone. It's ubiquitous. It's everywhere. There's like 4G coverage in most major cities now through a couple carriers, and this is expanding exponentially. So people are getting news not from as much CNN or New York Times much longer, but they're getting it from Twitter, from Facebook. Like things that I used to have to go search for are now delivered to me either through Prismatic or through something on my Facebook feed that somebody posts an article that says, oh my goodness, this is happening in an area that you're interested in or that we're interested in. So I think that's the long-term trend that we're seeing, is that computing is now moving into your pocket. Things are now personalized. Apps are now giving you information that you would otherwise get from a traditional media source. There's a weather app that's on your phone. Your stocks are coming from a different thing. And before, you would have to get that either from your bank or from the New York Times or a traditional media source. So I'm pretty excited about that. And
Are there trends that we're not mentioning that you're seeing in terms of consumption of digital information?
It's not. The consumption is that the digital information is no longer coming from one source. It's coming from a lot of your friends or people that you're following on Twitter, and that peer-to-peer or that sort of curated distribution of news is pretty powerful. I'm finding out things from first now, no longer because it's now being editorially driven from the front page of CNN or the New York Times. It's because Kevin Rose, who's one of my investing partners, tweets about it or puts it on Facebook.
You're creating your own curation. You're creating your community, your global community of curators.
And it's not that I'm actually, the beautiful thing is I'm not explicitly saying these are the people I want to follow about news. I'm just saying these are my friends, and somehow magically the news gets sent to me, and that's a pretty powerful thing.
Yeah, I was going to say, I think one of the interesting things about what you asked, Ali, is the velocity of things now is clearly accelerating. Things can go, as I say, go viral, go through your network, go through Twitter. And, the pace is really quick. And it's not just that stuff that we think about all the time, but it's actually the adoption of new devices is happening faster and faster. The iPhone was the fastest selling consumer device ever, electronics device ever. It was surpassed by the Xbox, then it was surpassed by the iPad. And if you look at all of that, both the device end and the service end, things are getting better. So for a consumer, this stuff is actually getting better. It works. Like things come out of boxes you don't need instructions for. Services you can just go to and they work for you. Apps or whatever, you don't need instructions. You can just figure it out. It's easy to use, and that creates velocity. So I think the biggest thing now is both for investing and sort of thinking about the world is what has momentum really matters, and what companies have it, why do they have it, are they going to be able to keep it? But there's real momentum now behind products because they can just get adopted so fast.
And Richard, for a lot of my viewers who are investors,
right?
At a stage later than where you and Wesley are involved. Is there still money in this for investors?
Oh, I think, we haven't mentioned this term, and I know we've only got a few seconds, big data, which was a big part of some of the previous panels I saw, and I think we've kind of touched around it, because it's like cloud computing, everybody's big data, like that's the new buzzword, but absolutely, we're looking at, we do a lot of advertising supported businesses, right? A little different than Wesley probably does. And we look at the impact that that's going to have on businesses and the opportunity it's going to create from an advertising standpoint to bring consumers everything they want, where they want it, when they want it, exactly what they want to have. We're just at the tipping point of that. So we think the opportunities are actually better going forward than they are in the past.
Richard, thanks very much. Great conversation. Richard Bressler is the managing director at Thomas H. Lee. As he said, Wesley Chan is a general partner at Google Ventures, and Jonathan Miller is a former chairman and CEO of the Digital Media Group at News Corporation. Gentlemen, good to talk to you.
Thank you.
Ali Velshi, thank you so very, very much.